If you have a mortgage, a car loan, a credit card, or even a savings account, what the Federal Reserve does with interest rates directly affects how much money stays in your pocket every single month. And right now, in February 2026, the Fed is in one of its most tense and divided moments in years. Today, I'm going to break down exactly what's happening with interest rates, what the Fed has done so far in 2026, and most importantly, what it means for you. Whether you're thinking about buying a home, paying off debt, or just trying to grow your savings, stick around because this video could literally save you thousands of dollars. Let's get into it. First, a quick 60-second primer for anyone new here. The Federal Reserve, America's central bank, has one very powerful tool: setting the federal funds rate. That's the interest rate at which banks lend to each other overnight. Now, you might be thinking, why should I care what banks charge each other? Here's the thing. That one number ripples through the entire economy. It shapes your mortgage rate, your credit card interest, your auto loan, and even the return on your savings account. Think of the Fed as the thermostat of the U.S. economy. When inflation runs too hot, they raise rates to cool things down. When the economy looks like it's slowing down, they cut rates to warm things up. For the past couple of years, the Fed cranked that thermostat all the way up to fight historic post-COVID inflation. Rates hit a 23-year high of 5.25% to 5.50% in 2023. Then, slowly, they started cutting. So where are we today? 3 cuts. The Fed made 3 consecutive quarter-point rate cuts in September, October, and December of 2025. Each cut was 0.25 percentage points. Then, at their very first meeting of 2026 on January 28th, the Fed hit the pause button. As of right now, February 2026, the federal funds rate sits at 3.50% to 3.75%. That's the lowest it's been since November 2022. But here's the tension. The Fed is deeply split on what happens next. In the January meeting, 10 out of 12 voting members agreed to hold rates steady, but 2 members, Governors Stephen Miran and Christopher Waller, voted to cut again. They argue rates might still be too tight and could hurt the job market. On the other side, at least 2 regional Fed presidents, Lori Logan from Dallas and Beth Hammack from Cleveland, have said they think the Fed should stay on hold indefinitely. Why? Because inflation, while improved, is still running above the Fed's 2% target. The December CPI came in at 2.7% year over year. And here's a wild card nobody's talking about enough. Fed Chair Jerome Powell's term ends in May 2026. President Trump is expected to name a new Fed chair soon, and whoever that is could steer rate decisions in a completely new direction. So what do markets expect? Futures traders are betting the next rate cut won't come until June 2026, with possibly one more in September or October. JP Morgan analysts expect just one more cut total this year. Let's talk about the big one, your home. If you're a home buyer right now or thinking about it in 2026, here's the data you need. As of February 19, 2026, the 30-year fixed mortgage rate averaged just 6.01%, the lowest since September 2022, according to Freddie Mac. That's a meaningful drop from the 7% plus rates we saw at the start of 2025. Bankrate's 2026 forecast projects the 30-year rate will average around 6.1% for the full year, potentially dipping as low as 5.7% if the Fed cuts and the economy cooperates. Experts at Realtor.com, Fannie Mae, NAR, and Redfin all project the rate ending 2026 between 5.90% and 6.30%. Now, here's something important that a lot of people get wrong. The Fed doesn't directly control mortgage rates. Mortgages are tied to the 10-year Treasury yield, not the federal funds rate. That's why even after 3 Fed cuts in 2025, the 30-year mortgage barely moved. It averaged 6.60% for all of 2025. But with rates now at 6.01%, that is meaningful. On a $400,000 home with 20% down, going from 7% to 6% saves you about $267 a month. That's over $3,200 a year. The catch is home prices are still elevated. The New York Fed reported that total mortgage balances grew to $13.17 trillion by Q4 2025. But here's a silver lining no one's talking about. Home prices are now falling in half of America's top 20 metro areas, according to the latest Case-Shiller Index. Bottom line for home buyers, if you've been waiting on the sidelines, 2026 may actually present a window, lower rates and softening prices in some markets. But shop around. Freddie Mac research shows buyers can save $600 to $1,200 per year just by getting multiple mortgage quotes. Here's the ugly truth about credit cards. While mortgage rates take time to move with the Fed, credit card rates respond almost immediately, and they've been painfully high. The New York Fed reported that credit card balances hit $1.28 trillion by the end of 2025, a $44 billion jump in just one quarter. American households are carrying more credit card debt than at any point in modern history. The average credit card APR right now is hovering around 20% plus. Even if the Fed cuts one more in 2026, that brings maybe 0.25% relief, dropping your APR from, say, 20.99% to 20.74%. That's basically nothing if you're carrying a balance. Here's what you should actually do in a high-rate environment like this. Aggressively pay down high-interest credit card debt. Look into 0% APR balance transfer cards if you can qualify. And whatever you do, don't add to that balance if you can avoid it. The good news is credit card delinquency rates appear to have stabilized, according to the New York Fed's Q4 2025 report, but they're still at elevated levels. This is a fragile situation for millions of Americans. Buying a car in 2026? Here's the rate reality. Bankrate projects that 5-year new car loan rates will average around 6.7% in 2026, potentially dipping to a low of 6.4%. 4-year used car loan rates are expected to average 7.1%, with a low of 6.8%. For comparison, the average new car transaction price is now over $50,000, and over 80% of new car buyers are using financing or leasing. Here's the kicker. Your credit score matters enormously. According to Experian, borrowers with top-tier super prime credit scores were getting auto loan rates as low as 4.88% in late 2025, while subprime borrowers were paying 15.85% or higher. Auto loan balances also jumped to $1.67 trillion by Q4 2025, a $12 billion increase in just one quarter. The takeaway here is if you have good credit, now is a slightly better time to buy than last year, but don't let excitement rush you. Even a 0.5% improvement in your rate saves real money. And new versus used? Consider carefully. Used car prices are still 33% higher than pre-pandemic levels. Here's the rare good news from the high-rate era. Savings rates are actually decent right now. High-yield savings accounts are still offering around 4.5 to 5% APY at online banks, and CD rates for one-year terms are averaging around 4% to 4.15%. But here's the warning. As the Fed cuts rates, these yields will come down, possibly quickly. Every Fed cut shaves a little off your savings rate. Strategy for 2026? If you have an emergency fund sitting in a regular bank account earning 0.01%, move it now to a high-yield savings account. That's a potentially life-changing difference on the same money. For money you don't need for 1 to 2 years, lock it into a CD right now before rates fall further. Once you lock in a CD rate, it stays locked in regardless of what the Fed does next. So here's the big picture for 2026. The economy is actually performing pretty well by most measures. GDP grew at a solid 4.4% clip in Q3 2025, and the Atlanta Fed was tracking a remarkable 5.4% rate for Q4 2025. Hiring is slow, but layoffs are also low. Unemployment has shown signs of stabilizing. But there are real wild cards hanging over everything right now. Wild card 1, tariffs. The Trump administration's tariff policies are creating near-term inflation pressure. Fed economists generally see the duties as adding price pressure that could delay rate cuts. Wild card 2, new Fed chair. Powell's term ends in May 2026. If former Governor Kevin Warsh takes over, some Fed watchers expect a shift toward lower rates, but no individual can dictate Fed policy alone. Wildcard 3, inflation stubbornness. The Fed's target is 2%. We're at 2.7%. Some Fed officials have openly raised the possibility of rate hikes if inflation reaccelerates. That would be a major shock to the housing and debt markets. Wildcard 4, total household debt. Americans now owe $18.8 trillion in total household debt as of Q4 2025. That's a $4.6 trillion increase since the end of 2019. That's a lot of financial exposure to any sudden change in rates or the economy.
So let me leave you with 3 practical moves you can make right now based on everything we covered. Move 1. If you're carrying high-interest credit card debt, attack it aggressively. The Fed is not going to save you on this one anytime soon. Move 2. If you have cash sitting in a regular bank account, move it to a high-yield savings account or lock it in a CD before rates drop further. Move 3. If you're watching the housing market, rates are improving. The spring 2026 buying season could offer a genuine window, especially in markets where prices are cooling. Just get multiple quotes and don't rush. The Fed moves in mysterious ways sometimes, but armed with today's data, you're not guessing, you're making informed decisions. If this video helped you out, smash that like button. It seriously helps the channel more than you know. And if you want a deep dive on any of these topics, mortgage strategy, CD laddering, debt payoff plans, let me know in the comments below and I'll make that video next. Subscribe so you don't miss it. I'll see you in the next one.